Long before he ever came into my office, one of my clients lost a significant amount of money in the bond portion of his 401k. And when that happened, he and his wife were stunned. They had always heard that bonds were the safe portion and that was the reason to have some bonds, that would create some safety in that portfolio. And yet here they were watching that bond portion go down just like the stock portion was. They were losing money in bonds and stocks. Now, when they came into my office getting ready to retire, they told me quite honestly, they were afraid of bonds. They were afraid of using bonds in my portfolio. They wanted to know, did I use them? And they were afraid that they were going to get burned again like they had been burned in the past. And they didn't want that to happen because they were no longer going to be adding money to their portfolio. They were actually going to be spending money from their portfolio. And so they didn't want to have bonds and stocks that were both losing money. Now, when we looked at this, they didn't actually have a bond problem. They had a duration problem. And when we addressed it, then bonds became one of the most important parts of their retirement portfolio. Now, today I want to tell you the same thing that I told them, show you the same things that I showed them. And I think it's important to look at this right now because bonds are back in the news. Now, we have interest rates that are elevated. We have stock market valuations that are stretched right now. The stock market is currently at an all-time high as I record this. And we have an incoming Fed chair that is signaling rate cuts ahead. So there's going to be some changes in how interest rates are managed, when rate cuts are going to happen. And so we want to understand right now, how's this going to impact your portfolio? And a lot of retirees are asking, should I add more bonds to my portfolio because of this environment that we're in? And the answer, in my opinion, is that bonds should play a part in every retiree's portfolio. I want to talk today about 3 things that have to do with bonds so that you know how to make sure they're playing the right part in your portfolio. So I want to talk to you about the duration of bonds, explain that in plain English. I want to tell you how much you can lose if you have the wrong duration. And then I want to talk about how you can match the right duration to the job that you need the bonds to do for you. And look at that through the lens of bucket planning so that the bonds that you're choosing are doing the job that they need to do for you, for your specific retirement plan. Now, let's start by talking about what duration is. Bond duration just lets us know how sensitive a particular bond is to changes in interest rates. And there's formulas that measure this, but that number gets reported in Morningstar.com or on the fund website for a bond fund. You can find that number so that you know what the bond duration is without having to know the math behind it. And basically, the bond duration tells us how quickly a bond moves, either positively or negatively, when interest rates change. So if we have a bond duration of 1%, a bond duration of, let's say 3, and interest changes by 1%, then that bond is going to change by 3%. The duration is 3, interest rate changes by 1%, so it's going to have a 3% change. If rates go up, it's going to go down by 3%. If rates go down, it's going to go up by 3%. It moves in opposite direction to the change in interest rates. If you have a bond duration of 7, then it's going to be up 7 or down 7% if we have a 1% change in rates. And of course, if we have a 2% change in interest rates, then it's going to be double that. That helps you have an idea of how much volatility you could expect to see in the bonds that you hold. And that lets you know how much could you potentially lose from a particular bond if interest rates change. Let's say interest rates go up. Well, back in 2022, the Fed raised interest rates very aggressively, the most aggressively in a very long period of time. And They were doing that to combat inflation that had gotten out of hand after COVID, and they had to raise rates very quickly, very fast to get inflation back under control. But in doing that, it impacted everything else throughout the markets, bonds, stocks, everything. Bonds moved, as I explained, in the opposite direction. So rates were going up, so bonds were going down. Those intermediate bonds went down by about 13% on average. And we had long-term bonds that went down by 20 to 30%. Those are big losses if you're expecting that that bond is going to be that safe portion of your portfolio, the same as my client had expected. Now, when you look at different bonds, you can have short duration bonds, say 1 to 3 years duration, intermediate duration bonds, or 1 to 5 years generally. Intermediate bonds would be 5 to 7 years. Then we have longer term bonds that would be a longer duration than that. And the longer the duration, the bigger the impact, because we're taking the duration times the change in interest rate. And that's where my clients had a problem, because in their portfolio in the 401k, they had had longer duration bonds. And when interest rates changed and the market also changed at the same time, they saw that the bonds went down by a lot at that point in time. Now, the lesson here is that you've got to have the right duration for the job that you need it to do. And if you've listened to some of my previous videos on this YouTube channel, you know that I use bucket planning with my clients. And I divide portfolios into 3 different distinct buckets. Bucket number 1 is for the first 5 years. And in that bucket, we want to have money that's going to be safe and secure and provide for the cash flow of the first 5 years without needing to dip into volatile market assets, without having that particular bucket of money impacted by changes in the economy, changes in the markets, all the different things that can happen. Bucket number 2 is for 6 to 10 years. That is the intermediate bucket. And then bucket number 3 is for beyond that. That's our growth bucket, so that we have the growth over the long term to keep up with inflation and have the money in the future that you need. So in bucket number 1, I use laddered bonds portfolios that have durations that match 1, 2, 3, 4, 5 years. And that way, the money is available at the point in time that it's needed. In bucket number 2, I use intermediate bonds because we can have a little bit more risk in bucket 2, achieve a little more growth in bucket 2, but not have long-term bonds in bucket 2, because we don't want that level of risk in bucket 2. Then in bucket number 3, the bucket for growth, I don't use bonds, because I believe that you want to take your risk in growth assets that are going to give you the growth that you need over the long term. So we're putting equities in bucket number 3 so that we have the growth that we need for the long term. Putting those together, having the right type of investment in each bucket, make sure that you have the right risk, you have the right return, you have the right growth, and your whole plan is doing everything that you need it to do. Now, in bucket number 1, along with those bonds that have the correct duration, you can also add in CDs, money market, other assets that are very safe and secure to complement and to fill up everything that's needed in bucket number 1. Some people sometimes say, should I just use only CDs? And often the interest rates on CDs are just not as good in order to provide all the return needed for bucket 1. If interest rates are high, then it's possible to use all CDs. But there's a lot of times that we do need to make sure that we're getting the correct interest rate along with the correct level of risk. Those two go hand in hand to make sure the whole plan works. And so once I showed this to my client and they understood getting the right bonds and CDs and short-term notes and, into bucket 1 getting potentially some bonds in bucket number 2 that were, again, the right duration, very intermediate, and then getting their growth assets in bucket number 3. And we put the whole plan together. They understood the job that the bonds would do for them and the job that all the other assets would do for them. And they were able to retire with confidence that the portfolio was going to carry them through the different time periods that were ahead of them. Now, what I'd like you to do, we're talking about what is duration. I'd like you to take a step back and ask yourself, what bond duration do you have in the bonds that you hold? If you don't know, then take a minute to look up your bonds and look up the actual duration. You can go to morningstar.com, or you can go to the webpage for the fund that, if you have a bond fund, you can go to that webpage, look up the duration and ask yourself, does this duration match the job that I need this bond to do for me? If it's a long-term duration, a long-term bond, and it's money you're going to need in the next 3 years, then that is a mismatch. If it's a short duration bond and it's money that you're going to not need for a very long time, then again, that is a mismatch. You want to make sure that you have the right investment for the job that you're needing it to do for you, because then you'll be able to achieve the goals that you have for that block of money or for that bucket of money. And so I want you to look at the bond duration that you have, compare it to the job you need it to do for you, and make sure that you have the right duration for your specific plan. Now, if you're not sure, if you're a little bit confused about all of this and how your investments line up with your retirement plan, feel free to reach out to me to schedule a time to talk. I offer a 30-minute gap analysis where we'll look at what you have, what you should have, what's the gap between those, and we'll have a conversation about how you can bring that in line so that your plan is going to work the way that you need it to work. And if you found this valuable, which I hope you did, please subscribe. I am going to do a video very soon on credit risk, which is the other thing to know about bonds. And every single week I add a video that has to do with retirement planning so that you can be on your best path in your retirement. So please like and subscribe, and I will see you again next week.